Welcome back, everyone, to The Deep Dive. This is where we take that overwhelming fire hose of crypto information, break it all down, and hopefully give you some purified, actionable insights tailored just for you. Today, we are strapping in. It's going to be a high-speed ride, technically demanding, I think. We're journeying into what could be the future of decentralized derivatives. Our focus is squarely on a platform that's really dominating the conversation right now around high-performance trading. Hyperliquid.
That's right.
And our mission today, well, it's to go way beyond just the headlines. We're aiming to dissect, all the available sources on Hyperliquid. It's a decentralized perpetual futures exchange. We really need to understand the core architectural decisions, the things that let it gain traction so quickly. Why is it attracting so much attention? And I guess the big question, does it truly represent the next necessary step for on-chain trading infrastructure?
Yeah, and this whole topic, it speaks directly to maybe the foundational challenge facing crypto right now. You could call it the latency versus custody paradox, maybe.
Okay, latency custody paradox. Unpack that a bit.
Well, for years, you basically had to choose, right? If you wanted the performance, the raw speed, the throughput, the really deep liquidity you need for high-frequency trading, you pretty much had to sacrifice custody.
Yeah.
You had to sacrifice security by using a centralized exchange, CEX. No way around it.
Right, you give them your keys, essentially.
Exactly. But if you wanted transparency, if you wanted self-custody, well, then your decentralized exchange, your DX, was inevitably slow. It was expensive, the gas fees, and it just lacked the liquidity depth you need for serious derivative trading. So Hyperliquid comes along, and it's a direct, almost aggressive attempt to just dissolve that paradox. So you can have both.
And the core idea, the defining nugget here that all the sources point to, is that this isn't just another app. It's not layered onto an existing chain like Ethereum or, Solana.
No.
Hyperliquid is a decentralized perpetual futures exchange built on its own dedicated Layer 1 blockchain.
Its own L1, yeah.
And the mission, like you said, is to fuse that CEX level speed and liquidity, get that really tight spread experience, but combine it with ironclad DEX level transparency and security.
Right.
They're aiming for zero compromise.
It's a massive undertaking. I mean, think about it. It's a total foundational redesign. It's not just an incremental upgrade on what came before.
Right.
And for you listening, understanding this platform isn't just about chasing the latest altcoin narrative. It's really key to grasping this significant structural shift happening in the market. We're talking about a move towards high-performance, genuinely on-chain derivatives trading. And derivatives, I mean, they're the engine of the traditional financial system, aren't they?
Absolutely. Trillions of dollars.
Trillions. And if they can move reliably on-chain with speed and security, the whole market structure just changes. It profoundly affects anyone trading beyond, simple spot buys and sells.
Totally agree. Okay, now before we fully dive into the technical architecture, start pulling apart the mechanics of this custom Layer 1. We actually wanted to touch on something important. It's something raised within the source material itself. Actually, it's about the content ecosystem, the thing that makes these deep dives even possible.
Right. Yeah, that's a good point. Because the sources we use, the ones analyzing platforms like Hyperliquid, they are incredibly dense. I mean, the amount of research, the technical understanding required, it takes a huge amount of effort just to synthesize it all into something coherent like this conversation.
Exactly.
So if you, listening right now, are finding this level of detailed, structured crypto analysis valuable, if it's helping you cut through all the noise, the shilling, and truly understand the architecture of Web3, well, we kind of rely on your engagement.
It's almost like a decentralized call to action, isn't it? Liking this, subscribing, leaving a comment. And it isn't just, a vanity metric for us. It's actually an essential part of this whole knowledge-sharing ecosystem.
That's exactly right. That engagement, it directly boosts visibility within the algorithms. It signals to the platforms and, frankly, to us that this kind of in-depth, hopefully unbiased analysis is valued. People want it.
Yeah, and it ensures that resources get prioritized. It helps fund the continued creation of quality deep dives just like this one.
So, yeah, if you want us to keep breaking down the latest alpha, the newest architecture, trying to make sense of it all for you, think of hitting like or subscribe as, well, supporting the decentralized research community in a small way.
Well said.
Okay.
Let's put that aside for now and get back to the core tech, right, the technology, because this is where Hyperliquid's choice, building their own L1, it almost feels like a political statement in the crypto world, doesn't it?
It kind of does, yeah.
We know they choose their own path. So let's be specific. What is Hyperliquid not built on? And why exactly did the existing big players, the Layer 1s or even Layer 2s, proved fundamentally unsuitable for what they wanted to build, which was, let's call it, an institutional-grade derivatives exchange.
Okay, yeah, the sources are absolutely clear on this. Hyperliquid is not built on Ethereum, and it's not built on Solana, even though, both were theoretically viable options people might have considered.
Right, the obvious choices, maybe.
The obvious choices, exactly. The core reason, it boils down to the specific needs of derivatives trading, which demands, like, 3 key things above all else. Predictable latency, really predictable. High throughput, obviously. And, crucially, protection against things like front-running and those volatile transaction costs we see on other chains.
Okay, let's take Ethereum first. Even with all the Layer 2 scaling solutions, Arbitrum, Optimism, all those, why couldn't they provide what Hyperliquid needed?
Well, Ethereum, even when you use an L2, it still operates under this shared security model, right? And a generalized block architecture. That means you're always subject to things like state bloat from the main chain. And you're vulnerable to fee spikes completely driven by unrelated applications. Some popular NFT drop happens, and suddenly your critical liquidation transaction becomes prohibitively expensive, or worse, gets fatally delayed.
Right, your trade gets stuck because someone's minting cartoon cats.
Exactly. And maybe even more critically, you're subject to MEV, maximal extractable value, where block producers, the validators, can actually reorder transactions in a block to profit themselves. That is absolutely catastrophic for derivatives trading, where the exact order, submission time, and execution price is everything. Hyperliquid needed to eliminate that kind of unpredictability.
Okay, that makes perfect sense for Ethereum and its L2s. But what about Solana? Solana's whole brand is built on speed, right? They claim, 50,000 transactions per second. Why bypass Solana?
Yeah, Solana definitely offered that raw speed, that high TPS number. But its architecture, historically, has struggled with consistency and finality, especially during periods of really high congestion.
We've all seen the outages.
We've seen the outages, exactly. Or just unpredictable block times. And that's fatal if you're running leverage positions where timing is critical. Also, even on a really fast chain like Solana, if you're still sharing block space with thousands of other different applications, you simply cannot guarantee the ultra-low, consistent latency that market makers need to reliably deploy their high-frequency strategies.
So it wasn't just about peak speed, but consistent, predictable speed.
Precisely. The primary goal, the absolute #1 objective, was ultra-low latency trading. They needed to match that sub-10 millisecond experience, or get very close to it, that you'd expect from a top CEX like Binance or Bybit. Traditional chains, even the fast ones, just introduce too much execution risk for that specific use case.
Okay, so that brings us right to the core mechanism, the architecture they actually engineered to solve this exact problem. You hear this phrase a lot, off-chain matching but on-chain settlement.
Mm-hmm.
Some sources call it a genius compromise, but compromise always makes me a little nervous. It suggests risk. How do users know that the off-chain matching engine isn't, rigging the game? What specific guarantees, maybe cryptographic guarantees, ensure integrity before the trade actually settles on their L1?
Right. That's the absolutely critical point. This is what differentiates Hyperliquid from just a sort of semi-decentralized model or a CEX pretending to be a DAX. The custom layer 1 chain they build, it serves really just one primary purpose: transparent, secure settlement of positions and collateral.
Okay.
The matching engine itself, the thing that takes in the order book data, calculates the best price, and executes the match that's run by a Hyperliquid centralized server. But it's run off-chain purely for speed. It needs to happen instantly, not wait for block confirmation.
A centralized server. That sounds like the CEX problem again.
But here's the key. Every single order placed, every cancellation, even every calculated liquidation, it's all cryptographically signed by the user's private key. And that signed intent is recorded directly onto the custom L1. So the L1 acts as this immutable, auditable ledger of both the user's intent and the final outcome. The real guarantee comes from the system being completely non-custodial.
Non-custodial, meaning they never hold your funds.
Never. Your funds are locked via smart contracts directly on their L1 chain, controlled only by your keys. The off-chain matching engine can propose a trade based on the order book, but it physically cannot move your funds without the on-chain settlement process validating the entire sequence. So if that centralized matching engine tried to cheat, let's say, execute a trade against your will or at a bad price, the smart contract settlement logic on the L1 would simply reject it. Because the cryptographic signature sequence wouldn't be valid, it wouldn't match the user's signed intent that's already on the chain.
Okay. So the speed comes from taking the complex, computationally intensive matching off the blockchain, away from block time constraints. But the security, the trust, remains because the actual collateral movement and the final record of ownership only happens on their own decentralized ledger controlled by the user's keys.
Precisely. And this bespoke L1, it's tailored specifically for the throughput demands of derivatives trading. The sources suggest its consensus mechanism, whatever it is exactly, is designed to prioritize incredibly fast finality and, importantly, cheap, consistent transaction fees just for trading activity. This highly focused architecture, it eliminates that competition for block space. It eliminates the crazy gas fee spikes we talked about, and that's what allows them to provide that CEX-like execution speed while, theoretically, retaining the core DEX ethos of self-custody and transparency.
It's fascinating.
Yeah.
And what's really interesting about this whole architectural choice is Hyperliquid isn't making this move in a vacuum, are they?
Yeah.
We absolutely have to connect this to the case study of DYDX, a major competitor.
Absolutely vital context, yeah.
Both platforms, DYDX and Hyperliquid, seemed to realize they needed to get off general-purpose chains to properly scale derivatives, but they took slightly different paths to get there.
That's right. DYDX took a very similar but distinct path. They migrated from being an Ethereum Layer 2. They used StarkX to launching their own dedicated blockchain built using the Cosmos SDK within the Cosmos ecosystem.
Okay, Cosmos. Why Cosmos for DYDX?
DYDX chose Cosmos not just for the potential speed, but critically for sovereignty and modularity. Using the Cosmos SDK and the Tendermint consensus engine allows them to customize their chain specifically for their needs, guaranteeing high throughput and rapid finality crucial for their order book model.
Right. And what does using Cosmos specifically, that Inter-Blockchain Communication Protocol, IBC, what does that give DYDX that maybe Hyperliquid's purely custom standalone L1 might miss out on, at least initially?
IBC is the key differentiator there. IBC grants DYDX almost instant interoperability with dozens of other sovereign blockchains within the Cosmos ecosystem. This potentially creates a much broader base for capital inflow, for liquidity sourcing right from day one. They can tap into assets and users from other Cosmos chains relatively easily.
Okay, so network effects built in, almost.
Kind of, yeah. Hyperliquid, by building a purely custom L1 from the ground up, achieves potentially the ultimate optimization for its specific purpose. But it comes at the initial cost of that network effect. They have to bootstrap their entire security, their validator set, their liquidity entirely from scratch. Whereas DYDX, you could say, plugged into an existing, albeit decentralized, network state and security model via Cosmos. The overarching trend, though, is crystal clear. Specialized high-frequency trading requires specialized, dedicated infrastructure, whether that's a sovereign Cosmos chain like DYDX or a wholly custom L1 like Hyperliquid. They are both reacting directly to the failures of generalized blockchains to adequately serve the demanding needs of high-frequency financial markets. So if we zoom out a bit, look at the bigger picture. The entire value proposition of Hyperliquid, what they're selling, it's really predicated on solving those two most critical failures of the early DX era, right?
Which were
Insufficient liquidity and just prohibitively slow or expensive transaction speed. Historically, those two factors combined meant that any serious trading capital, the big money, it just stayed centralized. It had to.
And flipping that, the direct, tangible benefits for you, the listener, especially if you're a trader, they seem pretty undeniable based on the sources. You gain access to these crucial tools, things like high leverage, perpetual futures contracts, advanced order types like limit orders, stop losses.
All the pro tools.
All the pro tools. But critically, without surrendering custody of your assets to some centralized entity. And that, I mean, that feels like the holy grail for any large market participant, especially anyone who got burned by, well, you know who.
That elimination of centralized counterparty risk, that is the absolute core driver here. It's huge. And the sources suggest the platform is very intentionally trying to attract a diverse but definitely demanding audience. We can probably segment this into two distinct high-value groups they seem to be going after.
Okay, group one. On one side, you have the group the sources sometimes call, maybe affectionately, maybe dismissively, the Degans.
The Degans.
Let's be clear, right? This is a term used in the sources, often referring to high risk, maybe retail traders. They're primarily seeking that maximum leverage, finding novel, highly volatile markets. They kind of thrive in that high risk, high reward environment.
Yeah, chasing the 100x plays.
Exactly. And for them, low latency execution is absolutely critical because even a 5-second delay when you're on 50x leverage, well, that position could be completely wiped out. Catastrophic.
Totally. But just as importantly, maybe even more importantly for long-term viability, Hyperliquid is clearly aiming for the professional traders.
Okay, define professional.
This includes algorithmic trading firms, institutional market makers, maybe even some smaller crypto hedge funds. These groups, they demand two absolutely non-negotiable standards. First, the security of self-custody. Often, their fund mandates or risk policies strictly prohibit taking on centralized counterparty risk. They have to hold their own keys.
Makes sense.
And second, they demand the technological performance, the speed, the reliability, the API access necessary to run their sophisticated, often latency-sensitive, algorithmic strategies profitably. They simply will not settle for anything less than CEX-level speed and stability. So Hyperliquid seems to be positioning itself as potentially the first truly viable bridge for that kind of institutional-level capital that insists on decentralized custody but needs top-tier performance.
And the sheer intensity of this demand, this need for a high-performance DX, it didn't just appear out of nowhere, did it? We have to drill down into that historical catalyst, the event that really made platforms like Hyperliquid feel not just desirable, but necessary. We're talking about the FTX collapse in late 2022.
Yeah, look, the FTX collapse.
Mhm.
It's not just background noise in this story. The source material explicitly cites it as probably the single greatest spark that fueled this whole architectural shift towards high-performance DX.
It was a watershed moment.
Absolutely. It was a complete and utter crisis of trust across the entire industry. People suddenly realized that even the most well-funded, the most seemingly audited and regulated CEX could literally overnight prove to be a complete black box, potentially backed by fraudulent counting, commingled funds, a disaster.
Yeah, the trust evaporated.
It just vanished. And that failure created this urgent, almost desperate demand for decentralized exchanges that could actually rival CEX liquidity and stability while permanently eliminating that single point of failure, that custodial risk, the specific need for a high-performance, non-custodial alternative that is the foundational economic driver behind Hyperliquid's apparently rapid growth. Post-FTX, capital is demonstrably willing to pay a premium, maybe accept greater technical complexity, just to guarantee self-custody.
Okay, so that sets the stage. Now, let's contextualize Hyperliquid within the existing competitive landscape. We should probably start with the platform that really represented the first wave of successful decentralized perps.
Right.
GMX definitely proved the demand was there, didn't it?
Yeah.
But its architecture is fundamentally different from Hyperliquid's.
Exactly. GMX was that crucial first wave. They absolutely validated the economic model. They proved that significant derivative activity will move on-chain if the incentives are right. They did that primarily through their unique shared liquidity pool model, the GLP token.
Yeah, the GLP model was innovative.
It was. GMX proved traders were hungry for these decentralized products. However, GMX operates using an automated market maker, an AMM model for its perpetuals. Now, this model can offer quite deep liquidity sometimes, but it often suffers from, well, less precise execution compared to an order book. There can be lag, and it might not provide the kind of razor-sharp price discovery that professional order book traders really demand.
Which is exactly where Hyperliquid chose to differentiate itself. They didn't go the AMM route. They went with the traditional central limit order book, or CLOA.
Yes, that's a fundamental design choice. Hyperliquid built its entire platform specifically optimized for the CLOB model. That's the model that, 99% of traditional finance uses for exchanges. By choosing the CLOB, they're signaling they aren't constrained by some of the inherent limitations of AMMs. Particularly, AMMs can be more susceptible to large price swings during high volatility and often result in higher slippage, especially for really large institutional-sized orders. So by prioritizing the CLOB structure, Hyperliquid is basically saying, we intend to compete directly with Binance, with Bybit, on their own terms. Speed and price precision.
Okay. And finally, just a quick comparison to Uniswap.
Yeah.
It helps define the niche even further, right? Uniswap absolutely dominates decentralized spot trading with its AM.
Thinking of spots, fine.
Thinking of spot swaps. But Hyperliquid is focusing squarely on this very different beast, the high-frequency perps market.
It's a really crucial distinction in terms of market segmentation. Uniswap revolutionized simple token swapping, trading ETH for USDC. Hyperliquid is aiming to revolutionize complex leverage derivatives trading. The technical requirements for spot swapping, primarily deep liquidity and accurate price feeds, are quite different from the requirements for derivatives. For perps, you need extreme speed, sophisticated margin systems, reliable liquidation mechanisms. It's a different world. Hyperliquid is specialized. They are deliberately carving out that specific market segment where the order book model and that ultra-low latency are absolute non-negotiable requirements. They're trying to move beyond the generalized liquidity pool structure that defined the first generation of successful DEX like Uniswap and GMX.
All right, this is where we pivot a bit. We shift from the underlying architecture, the how it works, to the more quantifiable reality.
Hmm.
If Hyperliquid is genuinely trying to steal significant market share from these established giants, both CEXs and DXs, how do we actually measure its success? What specific analysis points, going beyond just, the token price or whatever, should you, our knowledgeable listener, really be focusing on?
Yeah, that's key. The sources we looked at outline about 5 critical analytical vectors we should track. We absolutely cannot just rely on, say, raw market cap or even TVL alone. We need to look at metrics that reflect the actual performance and adoption of the trading infrastructure itself.
Okay, let's kick off with maybe the most intuitive one, but possibly the most important, trading volume comparisons.
This is the absolute lifeblood test, isn't it? It's simply not enough for Hyperliquid to have trading volume. We need to assess its volume as a ratio or percentage against the established market leaders.
Right, context matters.
Huge context matters. Analysts are constantly comparing its daily and weekly trading volume against the decentralized leader, so DYDX, GMX. But critically, they're also comparing it against the major CEX perpetuals desks, especially Binance Popes, which is the undisputed king. One source I saw indicated that Hyperliquid had recently hit meaningful double-digit percentages of DYDX's daily volume on certain days. Now, if true, that signals an incredibly rapid catch-up in a fiercely competitive space.
Okay.
Consistent growth in that ratio indicates genuine market penetration. It suggests the platform is successfully pulling traders, or at least trading volume, away from these established hubs.
Okay, but volume itself can sometimes be gamed, right? Wash trading concerns. So maybe a more sophisticated metric to look at is liquidity depth, which is usually measured by the spread. Can you explain again why tight spreads are so crucial for attracting serious professional capital?
Yeah, this is arguably the metric that professional traders and market makers look at first to determine if a platform is even viable for them. The spread, simply put, is the difference, the gap, between the best price a buyer is willing to pay, that's the bid, and the best price a seller is willing to accept, that's the ask.
The gap between buy and sell orders.
Exactly. Wide spreads mean it's expensive to trade. There are high implicit transaction costs, high slippage, especially for large orders. Market makers absolutely hate wide spreads. Tighter spreads, conversely, mean there's deeper, more accessible liquidity right near the current market price. And the sources we reviewed repeatedly emphasize Hyperliquid's apparent ability to achieve spreads on the major pairs, think ETHUS, BTC, USD, that are highly competitive, often reaching down to just 1 or 2 basis points.
Which is tiny, like 0.01% to 0.02%.
Exactly, incredibly tight. That suggests 2 things. 1, their off-chain matching engine is performing very efficiently, and 2, perhaps more importantly, their incentive structure for market makers is successfully bringing in the professional capital needed to constantly fill those order books on both sides. That provides the CEX-like experience everyone wants, poor liquidity, wide spreads, that instantly kills any chance of attracting high-volume professional trading.
Makes sense. Okay, let's turn to TVL, growth total value locked. Now, TVL is often used as a proxy for adoption in DeFi, but it can also be a bit misleading sometimes, can't it? How should we analyze the trajectory of Hyperliquid's TVL to understand its true health, not just hype?
That's a great point. We need to differentiate. TVL on Hyperliquid primarily reflects the collateral that users have deposited onto the platform. This is the capital used for opening positions, providing margin, maybe participating in liquidity vaults if they have them. So a steep, healthy, consistently upward TVL trajectory. That definitely confirms growing user trust. It means users are becoming comfortable locking substantial amounts of their collateral onto this custom L1 chain, trusting its security model and its smart contract integrity.
Okay, but how do we know it's not just airdrop farming capital?
That's the key distinction we have to try and make. We need to look beyond the raw TVL number and attempt to distinguish between potentially speculative TVL capital just parked there hoping for a future token airdrop and genuinely active TVL. Capital is actually being used for trading, for providing margin for market making. Some analyses try to look at the ratio of trading volume to TVL. A high volume to TVL ratio might imply that much of the locked capital is actively being utilized in trading, which would signal true platform utility and stickiness, not just passive speculation. That's a healthier sign.
Right? Active use versus parked funds.
Yeah.
I also found the emphasis in some sources on the softer metrics quite compelling. It's easy to just chase the big dollar figures, TVL, volume. But they also highlighted the importance of on-chain data that focuses specifically on user activity patterns.
Yeah, I think that's the behavioral data that really shows sustainability over the long run. We need to look beyond just the raw money figures and try to observe genuine community engagement and user stickiness. So metrics like the growth in unique wallets interacting with the platform, are new users constantly coming in. What about the number of active traders per day or week? And maybe most importantly, the retention rate.
Retention rate.
Yeah, are traders just trying it out once because it's new and hyped, or are they actually sticking around? Are they consistently using the platform week after week? High retention signals that the user experience, the speed, the unique security model, whatever it is truly compelling enough to actually change people's trading habits. It suggests real product market fit, which is ultimately far more valuable than just a temporary influx of speculative capital.
That makes a lot of sense. Okay, and finally, let's touch on a very specialized, highly technical metric, but one that's crucial for derivatives platforms: funding rates. Could you elaborate a bit on why tracking the consistency and predictability of funding rates might actually signal maturity better than, say, just looking at a huge TVL number?
Okay, yeah. Funding rates are specific to perpetual swaps, which are Hyperliquid's core product. The funding rate is essentially the mechanism that keeps the price of the perpetual contract tethered closely to the underlying spot price of the asset, like Bitcoin or Ethereum. It's typically a small payment exchange directly between traders holding long positions and traders holding short positions, usually happening every few hours, often 8 hours.
Okay, so it balances longs and shorts to keep the price in line.
Exactly. Now, professional traders, especially those engaging in strategies like basis trading or arbitrage between different exchanges, they rely heavily on predictable and rational funding rates to manage their risk and calculate potential profits. If Hyperliquid's funding rates are wildly volatile, or if they frequently become significantly misaligned compared to the rates on major global exchanges like Binance or Bybit for the same asset, it signals potential problems. It could mean market inefficiency, maybe insufficient liquidity on one side of the book, potentially even manipulation, or simply that the market there is too thin.
So instability in funding is a red flag for pros.
It's a major red flag for institutional money and serious arbitrageurs. Consistent, stable, and predictable funding rates that generally track the global market are almost a prerequisite for attracting that kind of sophisticated capital. So we absolutely must compare Hyperliquid's funding rates across different assets against other major exchanges. If they are consistently stable and in line, it acts as a powerful proxy indicator for the maturity, the efficiency, and the overall health of the platform's core price discovery and market mechanics. Much more telling than just a raw TVL figure sometimes.
All right, moving into our final section here. It's absolutely essential we maintain a critical perspective, right? No platform, especially one growing this fast and using novel technology, comes without significant risks attached.
Absolutely. Need that balanced view.
So what potential vulnerabilities did the source material highlight? Things that you, the listener, especially if you're considering actually trading substantial amounts there, should be acutely cautious about.
Yeah, the sources we looked at detail roughly 3 main areas of caution. And interestingly, they all relate quite directly back to their core architectural choice of building a custom L1. The first one is pretty straightforward: maturity risk. Building a custom layer 1 from scratch means, almost by definition, they have limited time operating under real-world conditions, under real stress.
That's the fundamental trade-off you make with innovation, isn't it? The platform, while performing impressively well according to the metrics we just discussed and rapidly gaining volume, is still relatively new compared to the alternatives. It simply hasn't had as much time to be stress-tested against sophisticated, coordinated attack vectors compared to, say, established, battle-hardened ecosystems like Ethereum or even some of the older, more established Layer 2s. This inherent newness factor, it just carries a risk premium. You have to factor that in.
Which leads directly into the second risk, which is potentially amplified because of that newness: technical risk, specifically concerning potential smart contract vulnerabilities or bugs and the core L1 logic.
Absolutely. Because they built their own bespoke L1 architecture, they are necessarily using a less battle-tested codebase compared to systems that leverage, for example, the standard Ethereum virtual machine, EVM, which has been audited and attacked countless times over many years. Security vulnerabilities and novel smart contract bugs are always a risk in crypto, we know that. But they are arguably compounded here by the sheer complexity of a custom-built stack that's specifically designed to handle highly leveraged derivatives trading, including complex liquidation logic and collateral management systems.
Yeah, a bug there could be catastrophic.
A single critical bug, maybe, in how liquidations are calculated and executed under stress, or how collateral is managed across different positions, could potentially lead to a rapid, catastrophic loss of user funds. That's pretty much an existential threat for any new L1 platform. This technical debt of being new and custom, it just has to be acknowledged.
Okay, and the third major risk factor is external. But arguably, it might be the most significant long-term threat to the platform's ultimate viability. Regulatory risk.
Ugh, the R word. Yeah, this is basically non-negotiable when you're talking about derivatives products, especially perpetual futures offered globally.
Why specifically perps?
Because perpetual futures are heavily scrutinized by financial regulators all around the world, specifically because of the high leverage often involved and their sometimes complex mechanics. Regulators often deem these products particularly risky for retail investors. So future regulatory actions, whether that comes in the form of direct sanctions against the platform or its operators, geographic bans preventing users from certain key jurisdictions from accessing it, or even outright prohibition of offering these types of leveraged products in major markets, any of those could fundamentally impact Hyperliquid's future operations and growth potential.
Even if they are decentralized.
Even if they claim decentralization. Decentralization does not automatically equal regulatory immunity, especially when identifiable teams or entities are involved in development or operation. This intense external threat from regulators, it just looms large over the entire decentralized derivative space, not just Hyperliquid.
Okay, so significant risks to consider. Maturity, technical, regulatory. But despite these risks, Hyperliquid is clearly operating and gaining traction within an intensely competitive environment. We should probably reinforce who the primary rivals are because they're all competing fiercely, not just for retail clicks, but for that crucial institutional market maker flow.
Oh, the field is absolutely hyper-competitive. You're right. We're looking squarely at DYDX as probably the closest competitor in terms of model. They are highly capitalized. They've successfully transitioned to their own custom Cosmos chain specifically for performance, and they definitely have a significant first-mover advantage in the high-volume on-chain perp space. Huge brand recognition.
Okay, DYDX is number one. Who else?
Then you still have GMX.
Yeah.
While using a different model, the AMGLP pool, GMX maintains very strong brand recognition and often boasts deep liquidity, particularly on certain pairs. They serve maybe a slightly different market segment, but they are absolutely still competing for overall crypto derivative volume and attention.
Right, different model, but competing for the same user's derivative trades.
Exactly. And finally, you have to mention Injective, another custom high-speed chain solution also built using the Cosmos SDK. Injective is focusing very intensely on building out a robust ecosystem specifically for derivatives trading, including options, exotic markets, and more. They're also directly competing to be the go-to specialized chain for finance. So yeah, Hyperliquid finds itself in at least a three-way high-stakes race, maybe more, for that crown of the specialized high-performance derivatives platform.
Okay, so let's imagine Hyperliquid successfully navigates these significant technical risks, manages the regulatory pressures, actually succeeds in carving out genuine market leadership, or at least a very strong position. What would be the lasting impact of that success on the broader Web3 ecosystem? What does it mean for decentralized finance, for DeFi as a whole?
Well, I think its success would significantly accelerate a really crucial, maybe defining trend that we're already seeing. The shift towards fully on-chain derivatives execution becoming the default expectation, not just the niche exception. If Hyperliquid can definitively prove that institutional-grade speed, latency, and reliability can be achieved on-chain while still maintaining that core ethos of decentralization and user self-custody, it essentially provides a validated architectural blueprint, a proof of concept that could inspire and guide all sorts of future complex DeFi applications, not just exchanges.
And what about the impact on capital flow? You mentioned attracting institutional players earlier.
That's the other major potential impact. Success would likely attract genuinely diversified liquidity into the DeFi ecosystem. We're talking beyond the existing crypto-native funds and degens. Yes, sophisticated retail traders would be a part of it, but more importantly, it could finally entice those traditional institutional players, the prop trading shops, the market makers, maybe even some banks eventually, who have largely stayed on the sidelines of DeFi due to performance and security concerns. If major trading houses actually become comfortable running their high-frequency, latency-sensitive strategies directly on a platform like Hyperliquid, That validates the entire thesis of needing specialized, customized, decentralized infrastructure for finance.
So it could fundamentally change how DeFi infrastructure is built.
It really could. Ultimately, the success of Hyperliquid and its custom L1 architecture could fundamentally redefine how decentralized trading infrastructure is designed and utilized moving forward. We might see a bigger shift towards prioritizing custom performance optimization for specific use cases, like derivatives, over the previous focus on generalized compatibility and shared security. It could be a major paradigm shift. Hashtag outro guess.
Wow. Okay, this has been an incredibly deep, I think, and quite nuanced analysis of Hyperliquid, looking at its specific architectural choices, its high-stakes value proposition, the metrics, the risks. For me, the core takeaway seems pretty clear. Hyperliquid represents this really technologically ambitious attempt to finally resolve that persistent latency versus custody paradox in crypto. They're trying to blend that decentralized security and transparency with truly centralized levels of performance. And it feels like a market demand that's been fiercely accelerated, maybe even necessitated, by the systemic failures and the resulting evaporation of trust that we saw back in 2022 with FTX and others.
Yeah, that foundational conflict, that tension between trust and performance, that's absolutely what's driving this wave of innovation. But you're right, the story is definitely far from over. It's still unfolding. So maybe to wrap up, we want to leave you, our listener, with a few provocative questions to think about. Things to mull over for further exploration, drawing directly from the challenges and the competitive dynamics we've dissected today from all the source material.
Okay, let's hear them.
All right, first question. Thinking about Hyperliquid's potential speed advantage, that custom L1 design, but weighing that against the existing network effects and brand recognition of rivals, do you really think Hyperliquid has the potential to eventually overtake established players like DYDX and maybe even GMX as the primary go-to destination for decentralized perpetuals? Or are the moats, the network effects of those rivals, just too entrenched, too strong to overcome in the long run?
Good question. Okay, what's number two?
Second question, this one's more personal maybe. If you are engaging in serious, high-leverage trading yourself, where literally seconds and absolute security of funds matter most, where do you perceive the risk to be truly lower today? Would you ultimately place more trust, more capital into a highly regulated but still centralized legacy CEX like Binance? Or would you opt for the completely custom, non-custodial, but perhaps less battle-tested decentralized model of Hyperliquid? Where do you draw the line today between regulatory risk on one side and technical or platform risk on the other?
That's a tough one. Really makes you weigh the different kinds of risk. Okay, final question.
And finally, let's think about the potential macro impact. If Hyperliquid, or a platform like it, successfully attracts significant, verifiable institutional adoption, we're talking real algorithmic trading houses, serious market makers, moving substantial volume onto on-chain perps. What specific ripple effects do you anticipate that influx of institutional capital will have on the broader altcoin markets and the entire crypto ecosystem? Will it bring stability, maybe tighter spreads, more convergence with traditional financial products? Or could it simply introduce new, perhaps unprecedented, dynamics of volatility and maybe even systemic risk into the decentralized sphere?
Definitely some food for thought there. Lots to consider about where this all might lead. Well, thank you for joining us on this deep dive into Hyperliquid and the future of decentralized derivatives. We genuinely hope this breakdown was insightful for you. We always look forward to hearing your thoughts and perspectives. We'll catch you next time on the deep dive.